Hey, what's up guys? John here. Jerome Powell just came out and said that interest rates are headed a lot higher than previously anticipated. Now, I think we're in the greatest economic rug pull of all time. I think that 2023 and 2024 is going to be something unlike anything that anyone's ever experienced before. We're going to witness something I believe far worse than 2008. I'm not saying this to scare anyone, but I'm going to lay out the facts. You know, I'm a really smart person once said that smart people see things for how they really are, and everyone else sees things for how they want them to be. Here's what is really happening. So please hit the like button. When you hit the like button, YouTube's going to share this content to educate more people about what's really going on so they can make smart financial decisions. Also, today's video is sponsored by a company I own, GreatCreditFast.com. That's GreatCreditFast.com. We help investors, people that want to invest, but they have bad credit. We help fix their credit so that they can position themselves for the best financing. So if you have bad credit or your credit's not where it should be, GreatCreditFast.com. Give us a call for a free consultation today at 561-430-5900. So take a look at this. So Fed Chair Powell said interest rates are likely to be higher than previously anticipated, right? And that Fed Reserve Chairman Jerome Powell on Tuesday cautioned that interest rates are likely to head higher than central bank policymakers had expected. Or what have they expected and actually came true? They said inflation was going to be transitory. Remember Janet Yellen's coming out saying, inflation will be transitory, this isn't going to be a problem. But yet inflation is costing the average, this is average, U.S. family, U.S. household, $11,500 per year. So think about that. It's an extra almost $1,000 a month that the average family is being forced to pay. That's a huge burden, a huge burden. But here's what I think is going to happen next. So the last almost 3 years, about 3 years now, they printed 40% of all dollars in existence in the last 3 years, since 1776. So in the last 250 years, 40% of all dollars were brought into the market, right? During that time, you had stimulus, PP loans, funding and supporting businesses and people. And you had mortgages were optional, student loans optional, utility bills optional. I mean, everything was optional. So it gave this, I mean, you could have been an investor and had no clue what you were doing and just basically put your money in some stocks and you would have thought you were a genius, right? And now what we're starting to see is a lot of those people that thought that they were genius stock pickers starting to, lose in a big, very, very, very big way. But what I think is going to happen is real estate. I think real estate is going to go through a change in which we've never seen in this country before, where it's going to be a hell of a lot cheaper to rent than it is to own. A hell of a lot cheaper. Here's why I think this. So right now, if you were to buy, let's say, a $500,000 house, which if you live in, most markets, that's probably what the median home price is, about $500,000. I mean, the average, national average, this is including locations such as like Nebraska and certain areas of Kansas, and the national average is around $429,000. So $500K is probably within striking distance of a home's value around your area. $100,000 down payment. So you have $100,000 in cash and an 8% mortgage. It's about $3,275, $3,275, right? Mortgage rates today, if you are the average credit score in America, which is 698, which you should not be the average credit score in America, you should be much, much higher than that, because the cost to borrow is going to skyrocket. So you're going to go from 7.641%. If you had perfect credit, 6.9. That difference fixed over 30 years, I mean, it's probably $100,000 in additional cost, but over 30 years, an extra $150, $200, $300 a month. It's a huge number. But what this plays out at 8%, this is not factoring in the 3 more interest rate hikes that they're going to be coming forward on. Some are saying 4 potentially this year. But if that does happen, and let's say that they do go to 4 and interest rates go to 10%, if that does happen and interest rates go to 10% and it goes to $3,832 a month, and this doesn't factor in for increased utility bills. Utility bills are set to skyrocket this year. Increased insurance rates, increased property taxes. It might cost you $4,500 a month to own the average home, in most markets in America. That would mean you would need to make 3x that to be able to afford that mortgage and have $100,000 down. So you need to make $15,000, $16,000 a month and have $100,000 in cash. What average family can do that? Unless you're 2 engineers in a household, or you're in a situation in which both husband and wife, both people in the house make $100,000 a year. Even if that does happen, I mean, you're barely making it. And if you are, why would you go spend $100,000 down, take $100,000 in cash to go spend $4,500 a month when you could rent something for potentially $2,000, $2,500, because that's what I think is going to happen. I think it's going to become extremely expensive to own compared to renting. And the reason for this is I lightly touched on this yesterday, but 40% of all mortgages in America from 2020 to 2021 were taken out at 2 to 3% mortgages. People are refinancing. Everyone was locking in these really, really cheap loans. What are they going to do when utility bills skyrocket, the economy starts to change, stock portfolios start to go south? People move from LA and they've got a place in South Florida. They don't want to be there anymore, but they don't have the equity in their homes because they put 3% down or 10% down, and the market softened, and they have no option. What are they going to do? They're going to rent out their home. But they're going to try to rent it out to try to break even at least. Of course, they'd like to profit, but if their cost is very, very minimal, they're going to do just that. They're going to rent out their property, for $2,000, $2,500, $2,800, $3,000. Just try to cover the cost. Tell the tenant, hey, you pay the utilities, you pay the actual, landscape, and you pay those costs, and I'll give you a good deal. And that's what I think is going to happen. We're going to start to see these trends nationwide, people moving back to where they were 2 years ago. We're going to see people, in recessions, people get divorced more often, job changes happen more often, all these things. People are going to start to, revert to turning into landlords. And so if the cost to borrow money goes through the roof and there's a ton of rental inventory, and this also does not include the 1.6 million units that builders are building right now that are getting set to be released this year, or the fact that 10% of all homes in America are sitting vacant. They've been vacant for the last 12 months, 10%. So what are they going to do? A lot of these people are going to start turning into landlords. They're going to rent out their homes. And so as this occurs, the real estate market is going to get pummeled. But on top of that, here's what gets really fascinating. If you look at BlackRock, you look at KKR, you look at Blackstone, you look at these big hedge funds that were doing these massive, massive real estate syndications, and they were buying buildings at 4% cap rates and 5% cap rates, sometimes even less, and they were borrowing tons of money at floating rate debt. They now thought that they had these tenants that were willing to pay $2,500 a month or $3,000 a month. They might say, hey, I could go rent a house for something, within the same price, right? I can go rent, have my own yard, my own privacy for something similar. And so these rents are stagnant. And so as these rents start to go down, what do they have? They have a situation, these landlords have a situation where the cost to borrow, when these properties, by the way, are not fixed over 30 years. They're adjustable, 3-year, 5-year, 7-year terms. So their rates, their interest rates, are going to go from 3% to 7 to 8, 9%. That's a problem. That's a huge problem. And as that's happening, rents are softening, vacancies are going to start to rise. So you're going to start to see a huge problem across commercial real estate. So what I think is going to happen is we're going to start to see more and more and more of this narrative where they say, oh, the U.S. economy is doing too well. That's bad for people who aren't rich, right? They're this whole inequality narrative. This situation is going to happen like this. Energy prices are going to continue to rise. They're going to say that the only way to combat this is they need to continue increasing interest rates to combat inflation. But really, if they wanted to combat inflation, what they would do is they would increase the supply of energy to draw down cost, making things more affordable to distribute, transport, and produce so consumers could actually, buy these things at a lower price. But if you're increasing the cost of energy and increasing the cost to borrow money, what you're essentially doing is you're driving this economy into a wall. And that's what's happening right now. And as this is all occurring, it says federal student loan payments could restart in roughly 2 months. People are borrowing money. If you look at used car prices, borrowing money, buying these cars where they're upside down in these cars, and they're not factoring in student loans. They're hoping Biden's just going to say, hey, you know what? Yeah, sure. You guys owe $1.75 trillion in student loan debt. Sure, a lot of those degrees are kind of meaningless. In this economy, you're not going to be able to make as much money as you previously anticipated. We might waive it, but we might not. So in the next 2 to 6 months, you could start owing, $300, $400, $500, $600 a month on your student loans. And so what's going to happen? It's going to be a domino effect. We're going to start to see people start to default across the board, and we're going to start to see people try to hold on to their properties, their 2 to 3% mortgages. You're going to start to see people hold on for dear life. And what are they going to do? They're going to try to rent out their homes. So If you're looking to invest in real estate, I believe we're going to see immense opportunity. If you're looking, to start a business, scale a business, I think we're going to see immense opportunity if you position yourself correctly. This is total U.S. household debt hit a record of $16.9 trillion during the fourth quarter, an increase of $394 billion, or 2.4% from the prior 3-month period. So consumers are stacking on more and more and more credit card debt, and as they increase interest rates, the cost to service that debt is going to continue to rise. What I think is going to happen? Crime's going to pick up a lot in expensive cities. Look at Portland. Look at San Francisco. A lot of these big box stores are pulling out because of theft and crime. It's very clear what's going on. We're in the greatest wealth transfer of all time. Smart and savvy real estate investors, smart and savvy business owners are aware of what's happening and they're positioning themselves accordingly. What do you think about this entire situation? Drop below, hit the like button, subscribe here. Subscribe also to my second channel. It's an interactive call and show and a podcast. If you want to invest in real estate, distressed real estate, when things hit the fan, GreatCreditFast.com. GreatCreditFast.com. Think about this. If you're a homeowner, let's say for example, you own a property and you have it free and clear and everything in the neighborhood to rent is $2,500 and you want to sell that property, are you going to be able to sell that property for $500,000 and get someone to pay $3,832 a month? No. Including the utilities and everything, $4,500 a month? No. Maybe 300, right? Maybe something around 300K gets you, 300, 350, maybe somewhere in that range. You own your own property, that's much more viable. So for someone to go out there, put $60,000 down, $300,000 purchase price, finance $1,800. It's crazy. This is at a 6%. So at a 9% interest rate, it's $2,166. So I mean, you would still see a 45% decrease in home listing prices. That's what I think is going to happen. I think we're going to start to see massive distress to come to the real estate market. It's going to favor the smart, the prepared investor that has great credit, cash in the bank, and a game plan. I'll catch you guys in the next video.